Hello, future debt-free millionaires. This is Zach Gitterwitz for another episode of our Debt-Free Millionaire podcast and personal finance course. That's season 1 of our podcast. It's going to be everything personal finance. So let's get into it. Let's start talking about what we're going to be talking about today, and that is investments. Now, one of the big things about investments is, there's a lot of risk in it. But what is investments? So some of you might not actually know what investing is. And that's when you put money into a place or buy something that's supposed to give you what they call an ROI, which means a return on investments. We actually talked about this back in week 3, day 4, but let's go over this just one more time. So if I want to buy, say, a stock of Apple, Amazon, Target, Disney, anything out there, something that has to do with the oil industry, something that has to do with the solar industry. Everything that we want to invest in, we have to investigate before we invest in it. And what we need to investigate is a lot of its history. We want to see where it came from, what it's doing right now, and what it's planning to do in the future. And the reason for that is everything that happens in the past shows how they'll be responding to things in the future, except if there's a major change. But history is the best way of finding out how a stock or a bond or anything you're going to invest in, commodities, crypto, real estate, you want to know the history of it before you invest in it. So in the past, we've had financial advisors, and we still do. But most financial advisors says, hey, I can get you the best ROI, or again, return on investment, of anyone else out there. I'm the guy to do the job. Well, interesting enough, there are actually mutual funds right now where you can investigate their history and where they're going in the future and make the same kind of decisions. Yes, they do have a little bit more experience, but the more that somebody puts money into a, say, mutual fund, which is, we'll go over each of these, but a mutual fund is basically a group of stocks. The more that they take that out of there and put it into another spot, and then they take it out of there and put it into another spot, there are fees that have to do with those. Every time they move it around, those fees are taken out of the money that you would have put into that stock or had in the original stock. And a lot of fund managers love to do that. And when they do that, they're wasting your money. But they can, because when you talk to them, they're going to say, oh yeah, we got you this great ROI of 20%. But what they didn't tell you is that you lost $20, $30, even $100 moving it from one place to the next. And then how much did they get you with that 20%? Maybe $200, maybe $100, maybe $10. You don't know. So it's really good to be understanding of what investments are before you get into them. So what I would say is, if you're to do them individually by yourself, you want to spend the time to get to know them. If you're going to use a fund manager, which I am not, I don't even claim to be, I don't play one on TV. But if you're going to get a fund manager, they are trained at getting you the best return on your investment. Some people out there, some other gurus, especially those that like gold or real estate, they don't want you to actually use these individuals. Actually, they don't want you to get into investments at all, not into stocks and bonds, or stocks and even bonds or mutual funds. They want you to put your money straight into real estate and doing things like that. But what needs to happen whenever you're investing is you need to do what we call diversify your investments. You should have money in gold. You should have money in real estate. But you should also have money in stocks, in mutual funds, in private companies if you can, in different commodities. You want to be able to have your money in different places just in case one falls. You has the other ones to keep you up. And this has to do with a lot of things in life, but we won't go into that. So an investment, again, is when you buy something, you get ownership for something because you think you're going to get a return on your investment or the money that you're putting in there. Meaning you're going to have more money coming out than you actually put into it. and that usually happens over time. So let's go over individual ones. Okay, so the first one to know is an individual stock. Say I buy, let's go with Walmart. Walmart's always shown great returns, and they don't play with politics. When someone tries to put politics into it, they try to back themselves out of it, saying, we don't do anything with politics. We're just trying to make money for our investors. That is a great stance. Any company that gets into politics is one you want to get out of. Because most of the time, I'll give you an example. There's something out there called ESG. It's basically the standard for how much E, environment, S, social, G, government, ESG, yeah. So out of those, environment, social, government, those are all things that are political. And ESG is basically a standard that a bank or a hedge fund will put on their investments, or the people that they will borrow to, invest with, and such. If someone is doing ESG, it means that they're not going for the best of their investors, their stakeholders. They're going for the best of their politics. And those are the companies you want to get out of, because most of those have a poor return on investments, but they're usually one of the biggest ones. And so they think, or they want you to think that you're going to get the best return because they're the biggest. The biggest is not always the best, but those with history are the best. So you want to be able to have someone or a fund or a stock that has history in it. And we went over some of the pitfalls of Disney when they went political. Totally tanked. Target, when they went political, they tanked. When Budweiser went political, they tanked. And those were all in the last year. And so whenever you get into an investment, look at the history of 1 year out, but also look back 10 years and see what kind of an investment they get you. Some of them go up and down, and there's really nothing that's going to come your way. Stay away from those unless you know that all of a sudden it's going to jump up. So one of the stocks that was really big this year was chips, and that's microchips. Those that are investing in building microchips because of AI, because of other technological advances, because of crypto, they have skyrocketed, and they had a 1,000 times return on their investment because they actually worked on their investment. They actually put money where they're going to get the best return in the company. And when the company grows, your stock, your bond, your whatever grows with it. Well, not your bond, sorry. Your stock or your mutual funds that has it in it will grow as well. So stay very vigilant of where you put your money or where you let your financial advisor put your money, because you do not want them putting in money in places that are political. Political, not the place to be. And those political people, a lot of those hedge funds are doing that so they can have control over Disney or control over Budweiser or control over Target. They're not going after the best thing for their stakeholders, the actual stakeholders, those that own their stocks, their investments and such. They're going over their politics. So, not a place to be when you want to make some money and prepare for retirement and become self-reliant. You want to look at the people that are doing their business as their business, looking at the best of their business, and are growing because they're investing in their business. The more they grow, the more you grow. Okay, so that's what investments are. And that's what individual stock is. Disney's an individual stock. Target's an individual stock. Budweiser's an individual stock. Nvidia. The chip maker. Let's see, what's the other ones that have boomed? There's a lot of, Walmart we mentioned. Those are the ones we mentioned, and those are the ones that the three have tanked, while the other ones have skyrocketed. Amazon has increased. I mean, who doesn't go on Amazon for something they need really fast and want it just delivered to them instead of going to the store? Everyone uses Amazon because it's free shipping. Walmart's also getting into that, and so they do free shipping as well. So you basically have to decide on which angle you want to go to, which investments you want to go into. But individual stocks will go up and down, as you can see in this little graph that's in this image that I'm showing. But let's go to the next one. The next one is really important. The next one is mutual funds. Now, this is not a picture of a mutual fund, but this is to show you that it's not just one stock. These are all individual stocks. Mutual fund is a collective of all the stocks, a ton of stocks. Whichever stocks that the mutual fund managers are putting their money into. And you can actually look at their history. You can look into their how they do business. If they do it with ESG and with politics in it, don't get into it. There's no reason for you to get into a place where they're going to lose your money or give you a small amount of ROI when you can put your money in places that will have a big ROI. Again, this is for your sake, for your self-reliance, for your future. So if you want to be in with politics, go for it. But you're not going to get the best ROI. That is guaranteed. Okay, going on. So again, mutual funds, you want to be able to have a diversification of mutual funds. You don't want one mutual fund because one will tank and the other one will increase. Okay, just so you know, I am getting over talking too much at that convention last week. Show my voice. My voice is going out, so I keep on having to take cough drops. It's not because I'm sick. It's because I talk too much, as you might be aware of right now. Okay. Anyways, let's go forward. So the next one. What in the world does a city center have to do with this? This is an investment, actually. So you're looking at buildings. If you're looking at the picture, you're looking at buildings. You're looking at a city center, community center, or a courthouse, or anything that's built by the municipalities. You're seeing an investment there. That was built most likely by investment money that was created in a bond. So a bond is when a corporation, a municipality, which is like cities or towns, or the federal government put out a bond. It says, we're going to build X, Y, and Z, or Z. And so we want this bond. So we want you to invest in this bond. We want you to buy this bond, and we'll give you a guaranteed return on your investment over a certain amount of time. Now, these are low risk because they're backed by either a large corporation, a city or a town, or the federal government. Now, a corporation may fail. A city may even fail, but if the federal government fails, your money's lost no matter what you put it into, minus maybe commodities and real estate. So bonds are very low risk, so they're fairly safe. They have a lower return on investments than a stock or a mutual fund, but you don't normally lose money in these. You only increase it at a steady rate. So most people that go into retirement, they're going to put a lot of their money into bonds, and they're going to slowly take money out of it because their money will continue to increase. If you have it in the mutual fund and you're trying to retire, you're going to have ups and you're going to have downs, and you're going to have ups and you have more downs. And so you want to make sure that you're putting your money in the right spot. Okay. So, whoops. Moving forward, let's go. Let's get this out of there. Okay. Moving forward, we're going to go into the next one, which is individual companies, private companies. So, if you can find a private company that needs investment, they're great to get into if you know that they have a promising future. Most of these small individual companies have very little history, but you can actually ask for their books and be able to see everything that is going on in that company. You want to be able to see how well they're doing and how well they will be doing, especially if you know what's going on around the area. If that city is about to boom, or if it is in the process of a boom, meaning it's taking off, there's a lot of the economics for the city is great, then you want to get into a company, especially like a retailer, because they're going to have more people coming in over time, and their revenue is going to excel. If you're going to go into a plumbing company, a lot of times those service companies stay pretty steady. But if you know that they're going to be doing something that's going to bring more business in, or it's going to grow their company, you want to get in, because as they grow, again, as they get bigger, your money gets bigger, and you want to be able to have part of that. If there's a possibility that they're going to fail, you do not want to invest in that, because you know what's going to happen. Okay, so these are sometimes called founders. Those are the ones that find the company or build the company. There are individual investors, but there are also venture capitalists. So individual investors, that's you, that's me, that's normal people that want to pay a business and get something out of it, get ownership out of it most of the time. And when it grows, you grow. A venture capitalist is basically a large organization who wants to buy parts of a company, especially when it's starting up, because they want to jump in early before the profits are made. And then when the profits are made, that's when they get their investment out. They pull money out because they're going to make a lot more money after it's become successful. And before something happens, they're going to pull their money out. But that company should be able to stay steady, even though they lost their money. Or if they sell, that's when the venture capitalist says, hey, great, you're selling. I want a portion of that. This is how much I own of the company. I want that portion in cash. Thank you so much. And it's done deal. Some of them, and this is usually is discussed when you go in to get an investment as a business. And we'll go over businesses later on. But you'll go into an office of venture capitalists, and they'll say, great, we want to invest. We want to know what your exit is. And you're going to say, my exit? It's like, yeah, how will you get out of this company? Well, if you say, no, I'm going to stay in this company forever, I'm not going to sell. They're like, then why would we invest in you? Because how do we pull our money out? How do we get our profits? Because we're putting this money into your company. We want to be able to get money back, which makes total sense. Well, you say, okay, so my exit, if you did this on the spot and turned around in that meeting, they throw you out because you haven't thought about it. When you go into the meeting and you say, we have the plan. We are going to sell in 5 years when it hits 1,000x what we put into it. And it's going to be at this rate, this price, everything is up at that point. And they're like, ooh, we like that. We understand your market. We believe in what you're selling, trying to sell us. We're in. We're going to buy part of it. And when you sell, they will sell. They're going to sell their portion, and they're going to make their money right there. What they could also do, or what you could also do, is say, well, I don't want to leave this company, but I'm going to make it go public. And when it goes public, what happens is every share that the investor has, the venture capitalist, the VC has, they're going to be able to cash those in because it goes on the public traded market. All stocks that you put into there, they can also put into there. And when they start going up, that's when the VCs say, hey, I've got 1,000 stock in here. This is my ownership in this company. I'm going to sell them each individually and reap, if it's $38 per share, they're going to reach 38,000 because they have 1,000 shares of this company. And so they're going to take all that $38,000 out. Now, if they had 10,000 or even 20,000 times $38 per share, then they're really making their money back, especially if they put in like $10,000. That's where the VCs want to get their money. And that's where you want to get your money if you're investing in a private company. Okay, so those are the major types of investments. We're not going into commodities. We're not going to go into real estate, any of those things. This is the stock market. This is ownership in a company that we're going to be talking about today. We'll talk about all those other ones later on, but this is what we're focusing on. So one other thing to think about is you're going to have all these funds. You're going to get to retirement, or maybe not retirement. Maybe you want to be able to live off that money just for living expenses. You can actually do that. So there are, and I'm going to go over this in just a few minutes, there are what we call dividends, where a company will actually pay you a certain portion of their proceeds as a dividend for all the stakeholders, all the stockholders. Anyone that owns stock in the company will get a dividend based on the amount of shares they have in the company. But say you want to retire on the money, then you would keep it in there, and all those returns, all those dividends would be put back into the retirement plan and grow your investments. And you can't touch it until you're 62, 65, or 67 for Social Security. And that's usually when people retire at these days. They work until they're 62, 65, or 67. Okay, so let's talk about the past. Okay, so the past, people were investing in small stocks, mutual funds, but they'd use investors to do it. Well, these stockbrokers have a lot of experience. Now, all they need is a certificate. There's certain franchises that are out there where the person's not actually trained very deeply into stocks. They are trained enough to be able to run the party line as the franchise would have them invest. So also keep track of that. You want to be able to know what kind of fees that they're taking out. Stockbrokers are always taking out fees. They're always taking out commission. They want to make money off of the money that you're investing. They don't have the money to invest as much. They want to live off of your earnings, or 1,000 people and all of their earnings. And so they get to pull money out as they make it for you. So you want to see what that person's making every time that your stock goes up, or every year, what their commissions are, what their fees are, and talk to them about that. I go to a brokerage. I use 2 different brokerages, but I do not actually ask them to invest for me. I put into mutual funds that I actually trust and have shown me great returns. But basically about 12 to 14% returns year over year. So I trust these mutual funds. And again, these are the only stocks or bonds or investments that I do that are like traded on the stock market or private companies. I don't actually invest in other people's companies because I'm growing my own companies. But in the past, they did some things, and these days it's quite different. Because in the past, you had to go through these stockbrokers in order to make your money. Now you can go to fidelity.com, and all of a sudden you can invest your funds. You can sign up for a 401k. You can actually create IRAs and do the investments yourself. You don't have to go through these places. You can use places like Charles Schwab, or there's a whole bunch of them, or like Robinhood, where every trade is $0. Not every trade. There are some trades that are $0. They actually have to make money too, remember. But Robinhood is supposed to be the trading program for the middle class and lower class, and even now the higher class. I should say income, not class, because sometimes we have more class than the higher class. So you have the lower income, the middle income, and the higher income. Robinhood was set up for that, and there's a lot of ones just like Robinhood, which have near zero fees. So look into those as well. Okay, next off, your stockbrokers, strengths and weaknesses. A lot of times, they look exactly like a tomato market. They look like all the different tomatoes that you could go to in the grocery store. Yes, I'm using this analogy. Some might be red, some might be off red, some might be orange, some might be yellow. They're all a shade between red and yellow. You don't know exactly which one they are. You want to be able to see their history. Now, a lot of the franchises, they won't show you the history. You have to go off the fact that, and I use these in air quotes, that their company is their history. That's where the strengths are. But you want to weigh the pros and cons of using any broker. Are you going to get red tomatoes, or are you going to get yellow tomatoes? Now, different brokerages actually have different strengths and different weaknesses. That's why I actually have 2 of them. I went with one that has certain strengths in one thing and certain ones that have certain strengths in another. So you want to be able to look at what you're doing and know who you're trusting with your money. Let's give you a second part. Okay, so this might look weird. These are different seeds, these are all commodities. But this is seeds and spices and beans and other things. But this is also the fact that there's so many brokerages out there. But we're not going to be talking about the brokerages. We're going to be talking about diversification. You want to be able to find a broker also that's not putting your money in one place or 2 places or even 3 places. You want to have a diversement. So you actually might say these green beans or green peas are your investments with this one stockbroker. The yellow beans are with this other stockbroker. These ones are gold. This one is real estate. These other ones are everything else. You want to diversify your investment because you know at some point one of these is going to tank. At some point, one of them is going to go out of business, is going to lose everything. Mutual funds have a very low chance of it. Well-established corporations have a less likely that's going to happen. Municipalities, governments, and such, most likely not going to happen. But if you're going to go for private companies, one of those, you know what? 9 out of 10 are going to go under or not making any money. But it's that one that will make you a millionaire. So, but you don't know which one it is, and you might not choose that right person. But you do want to diversify because there's a chance that you'll find the right one. Same thing goes with cryptocurrency. I have like 30 different cryptocurrencies that I'm in. Most of them have dropped, have tanked since I got them. Some of them I got because I was actually, I went through a training and they gave me free of that one cryptocurrency. And the $3 that they gave me out of cryptocurrency, it wasn't much because it was like 3 minutes of my time to teach me about the cryptocurrency. It's now at $49 and I didn't pay anything for it. But it's not one that's like a very solid one. So at some point it could go down to 20. It could go back down to 0. I don't know. Especially when you're doing commodities in the sense, not gold. Gold and silver are very established. But something like cryptocurrencies. You buy 10 of them, 9 of those are going to go to 0. Most likely, at some point. Good chance you're going to find good ones, and you're going to have like 5 out of the 10 that will stay good. And it's those 5s that will make you a millionaire. Truthfully, you diversify. Most of them will make you a thousandaire. But because you have it over 10 different investments, that'll make you, if each of them go up, most of them go up 10,000s or tens of thousands or hundreds of thousands, at some point you're going to become a millionaire because you have diversified your portfolio over a lot of different things. Okay, I'm not going to go through all of these. There's other things to do, such as balancing your portfolio. You want to have your portfolio, all your investments in different places. You don't want them all in stocks. You don't want them all in mutual funds. You don't want them all in bonds. You don't even want them all in everything that we're talking about today. You do want to have gold and silver and crypto and real estate. Don't spread it out too much that you don't put them in the best places, but be educated on where you're going to put your money and find that one that you're going to put it in, put a good amount in there, put the rest in other places, but keep it moving, keep it going around. We already talked about dividends. That's another thing. There's some companies that when you invest in its stock, they will pay you a dividend every year. Look into that. Those are great things to have. Okay, so say this company, now you know what's happened to malls. They've all actually decreased in their value because people stopped going to malls. So a lot of these big stores, they're not making their money in their stores anymore. You don't have crowds in their stores anymore. You have crowds going online to their websites and ordering things there. You have it off of other things. So when it comes to dividends, if a company tanks, they won't be paying you dividends. If it skyrockets, it'll be paying you dividends. You want to know what's happening with the market. If you invest in a chain of basically stores that go into malls, I'm sorry, you're losing money hand over fist because the malls are going down. But when you got into that, you should be able to know that. While you're in it, you should be able to know that as well. If you have a money manager, they will manage your money in that sense. They actually know what's going on in the economy, and that's why it's great to have them. If you have the mutual funds, the mutual fund managers know it, and it doesn't cost you anything. It costs you basically whatever the mutual fund managers take out, but it doesn't cost you an extra fee for a broker to get you into mutual funds, to get you into such. Not everyone has to have their hands in your pocket. And so, yeah, diversification is so important, and watching what happens in the history of the company, in the history of what's happening around it, and is it influencing its market, you want to know that because those are things that are going to affect it. Such as, and we already talked about the history, news. When new news comes out, you know that that's going to affect your investment. If news came down of a lockdown Walmart, it would skyrocket. Amazon, skyrocket. Target, tank. Aldi, they're getting better. They'd tank. Grocery stores, tank. Because people aren't getting out of their houses. Now, that's if we ever did a 2020, which I don't think will ever happen again, because America, at least, will revolt against them and they will break out. Okay. Strengths and weaknesses in your stock investments. You want to keep track of that. Now, a lot of times you're not going to actually do a lot of the work. Most people don't want to do a lot of work. They want to invest, basically set it and forget it, and come back later on and there be 100 times the money that was originally put in there. So what you want to do, if you're going to do an individual stock or investment, you want to see certain things. Let's just take stocks. Let's take an actual business or even a private business. You want to see what their debt to income ratio is. Oh, sorry. This is if a company's booming because recessions happen. And companies. Okay. This is your debt versus equity ratio. The guy is looking at his debt, obviously. He's saying we have that much debt over equity. You want to know a company. So the way to find this out, the number, the debt to equity ratio, is you want to find this number. You divide the total liabilities on the company's balance sheet. This is everything that they owe, all their expenses, all their overhead, everything. And you want to divide that by the amount of the shareholders' equity. So for those with a low risk tolerance, that number would be around 3.3 or less. If they have actually a low amount of debt compared to their shareholders' equity, then they actually have a good, solid company. If they have a huge amount of debt and a small amount of shareholder equity, that's big. That company's not going anywhere. That company's either going to take off because of the technology that they're going into, or it's going to tank. If it's not going to take off, your money's either going to stay completely steady or it's going to tank. So watch out for that. The other one to know is your price earnings ratio. So to find out this ratio, divide the company's share price, so how much the price is worth, by the earnings per share price. If a company trades at $40 per share and the earnings per the share is 2.5, you got that? Earnings per share is 2.5, then the ratio is 16. Use this to investigate similar companies. And you want to see the lower the ratio means the more the earnings are increasing. Again, the lower the ratio means the more that the earnings are increasing. So you want to be able to get a company where their price per share is actually increasing over the earnings of the per share. Yeah. Yep. Because that will give you the opposite. Price per share. So if it goes down to 30 and the price per share earnings, wow. I'm not explaining this very well. As I said, I'm not a money manager. Let me cut this part out. Cut. Okay. So in the end, what you want to do is you want to be able to invest in companies, but you want a large range of different investments to go into. You want to go to a store that has all different types of products. If you're looking for all different types of products, you want to be able to have a solid investment portfolio. You want to be able to have as many, and you're not going to go to a store to do this. I'm just giving an example. The analogy is you go to a store that has a lot of different commodities because you know that something might tank. Someone might, let's just say the world stops wearing skirts. The women in the world stop wearing skirts. And the company was all based in completely skirts. What would happen? That company would tank. It would go under so fast because the world does not want skirts anymore. But let's say that the store had skirts and blouses and pants and so forth. What would happen if skirts went away? No problem. They would put something else in its place. And so because the skirts went away, the slacks went up for women. So all of a sudden, those that had the investment in slacks, that company would still stay steady because they had slacks. Now, a mutual fund, the idea with a mutual fund is you're going to a Walmart that doesn't just has clothing, it has office supplies, it has groceries, it has electronics, it has this, that, and the other. That allows for if groceries for some reason tank, the value of the groceries or the money's earned from groceries, if that stock tanked, you would have all these other things to bolster it up. And the hope is that if a mutual fund, if you have one stock that goes under or starts dropping, they would actually sell that and replace it with something else to bring up your value. And so this is the idea when it comes to investments. You want to be able to have a steady set of investments. Again, we're not talking about commodities as much. We're talking about stocks, bonds, private companies, and mutual funds. You want to be able to have a diversification of all of your investments. So that if something falls, the rest will hopefully take up its place. And if this one falls, and these don't go up, at least it will keep it somewhat steady because they'll replace that with something else. The skirts, they'll replace the skirts with something else, and then it will continue to climb again. So this is my talk on investments. Wasn't the most exciting. It's not real estate. It's not commodities. It's not gold and silver and all these other things. But it is so needed for you to know about. Again, stocks, individual companies have privately traded shares of their company. Mutual fund is a large amount of these different stocks put into a certain fund. So if one drops, the other ones hopefully will keep it up. You have the private companies. You can actually buy a private company, say a store, say a plumbing group, say some sort of technology. That's a great thing to put investment in. Bonds, very, very low risk, very solid, guaranteed almost, and yet they have a small return. All these other ones have higher returns than the bonds. But if you're going to be retiring soon, you want to put your money in stuff like bonds because you know it will be there when you need it, and it will continue to increase slowly. So thanks so much for joining me on this Debt-Free Millionaire podcast. And if we haven't made you in a mindset where you want to be debt-free or a millionaire, or even better, a debt-free millionaire, stay tuned because we will be. Thanks so much for joining us, and we will talk to you next time. Take care. Bye.